basically off until right now.
Yeah.
Good
Did you
deal.
serve at all? Were you military?
Would I?
Rock?
Well, I just started. So I just posted live on LinkedIn. We can kill a minute or two while we wait for Jeremy. But for those watching on LinkedIn, this is Real Fridays on Friday at every Friday at 12:30 with Brock Cassidy and myself, Rick Rock, and Jeremy Potter, where we talk about really all things housing, mortgage, real estate, public / non-public information, like information that isn't necessarily proprietary, but because we have deep relationships in the business, we often have insights on people, places, things, companies, movements in the market that we tend to, have insights on that a lot of people just don't have, And today we're super excited to have a good friend of mine, Ron Gensrud, a 30-year veteran. Happy Veterans Day, Ron.
Thank you. Appreciate that.
You served in Germany and back in the war. No, just kidding.
Before that.
But you served. You were. Did you enlist? You were Army enlistment, and then you were you were in Germany. You were stationed in Germany for like 2 or 3 years, weren't you?
Almost 4 years.
4 years?
4. Yeah, I was financed in the military. It was actually a really good job. So didn't have to really do any combat or anything like that. And got out of the active duty, went into the National Guard, and finished out the remainder of the 8-year commitment there.
Well, that's great. Well, no, hey man, happy Veterans Day, and
I appreciate that.
And a lot of people ask the question, what's the difference between Veterans Day and Memorial Day? And it's like, well, there's a big difference.
There is.
So happy Veterans Day for those who obviously have served. My father was, Air Force, and my sister with the Air Force Academy, and I had 3 brothers that were in the Army. So and another brother that was in the Air Force. So certainly happy Veterans Day to them, and any family member in Jeremy's family or Brock's family or the military. It's an elite and beautiful class to be part of, for sure. But no, look, what's headlines for the week? What would you say to be, since Jeremy's late, I want to put him on the spot first. What would you say to be the most notable thing that sort of rose to the top of the last week in the headlines?
What time does this thing start? No, I'm just kidding. Good to see you, Ron, and thanks for joining us. And I think some of the volatility that follows with that NAR lawsuit, I know it happened last week, and you talked about it a little bit, but I think some of the reverberations still made a little bit into the ecosystem this week around follow-on, noise, so to speak, what's going to happen and questions. And then I think the other thing from this week was just more around economic data. Like, I think people are starting to think about the political and economic conditions for the next 6 to 8 weeks, but also 6 to 8 months. And, we don't talk a ton about like the rates day to day. That's not exactly what this show is about, but I think some of those larger items are starting to bubble up now for what the projections need to look like. I'm hearing some people are starting to do 2024 planning, offsites or budgets or what have you. And so that's naturally a time during strategic planning when these things come back to the forefront. So we got a lot of those questions this week too.
Yeah. No, similar on the rate side. I mean, on the mortgage side, certainly at Cross Country and other mortgage lenders I talked to, it's the largest single improvement in rates this year that's occurred over the last, week to 10 days. So, I mean, I think it's eased some of the pressure off of lenders a little bit, or at least given a little bit of optimism that we're not going to be at, 9% anytime soon. It's almost like the fear in the marketplace is so pervasive that if we're at 8%, there's always talk of 9 and 10, rather than, 8 is 8. And now that we're at 7.25 or so, the reality is, it's a huge positive step momentum wise. But I will say this though, I don't think rates necessarily are I think it's a false indicator actually from the success and the stability of mortgage companies. Cause I was talking to a mortgage company today, mid-market, small, enterprise. They do some business in Minnesota where Ron is from. And they do about 60, 70 million a month in volume. So for all intent and purposes, a pretty good mortgage company. And from a mid-market, less than enterprise, but mid-market standpoint. And he was like, Rick, more volume right now, unless it's like a lot more volume, but more volume really doesn't, a little bit more volume really doesn't help us. Like I still losing money or close to it. It's still extremely competitive. We're still heading into the winter months. I'm still having to capitalize and put my own money, my own cash that's in my company at risk. I'm still having to dip into that cash, which makes me nervous. I'm still having to invest that in leadership and growth. And these are areas I've cut back on. I've cut back on, transition bonuses or aggressive sales approaches. I've cut back on my marketing department. So I'm kind of like in this process of like, how do I grow while I'm cutting back to right size the organization? And that's a huge challenge. You can't cut your way to growth. You have to have cash reserves, and you got to say, look, my advice to him was like, look, you're going to have to take $1 million or $2 million, whatever you're comfortable with out of your reserves, and commit that you're just going to spend it. You're going to lose it. But you're going to focus it on sales and marketing efforts to grow. With a hope that sometime in the second quarter or something, we sort of come out of this malaise and we're able to sort of drive mortgage growth. So I don't necessarily think more production on a lot of mortgage companies is really going to matter. For most mortgage companies, I think they're still going to lose money and they're still going to struggle, even if there's 15 or 20% more volume. To a company doing 50 million a month, now all of a sudden they're doing, 60, 62, 64. Does that really get them out of their ditch? I don't know if it does. So
yeah, I think the other big difference that I saw this week compared to the last, let's say 3 months, 4 months, maybe even 6 months, was that it seemed like directionally a lot of the public company data was, I don't want to say good, let's say less bad, right? Rocket was publicizing that they got their loan margin back where they wanted it. Basically, UWM had some really great data on their profitability. Blend even, it was projecting a really strong path to profitability, which I don't think anyone really believed a quarter or two ago. So, I mean, the handful of bits of public company data that happened to come out this week related to mortgage seemed directionally better. I think less bad is probably the right phrasing. None of it was, 2021 numbers or 2020 numbers, but yeah, I don't know if you guys took a look at any of that, but that seems like at least a positive thing to shine a light on this week.
Go ahead. No, go ahead. Yeah, sorry about that.
It made a lot of sense to me. Not just because digital lenders like Rocket have been known to protect the margin in these moments, but also with purchase, it makes sense too. There's less of that like really competitive, urgent shopping around rate. Like these are life events moments, right? Same thing with second lien business too. Second lien business has been pretty strong for independent mortgage companies as well. Reason is it's less rate dependent and it's more, I need to do this. I want to do this. I've got something going on. I'll figure out the savings when things change or don't, with the merged rate later. So I do think it's good news overall for the market, to Brock's point. And I do think it makes sense because we're in a less rate dependent environment. It's like, I'm going to do what I'm going to do for my life at this point for a lot of customers.
Yeah. Yeah. It just seemed like there's a little more action. It sounded like maybe a couple of new programs. Better had a launch this week with a new platform, and it sounded like Blend had some positive data that they released. So it seems like that online lender, startup lender kind of cohort, maybe coming back into action a little bit. So we'll take it.
One thing that I forgot to do, guys, and I'm terribly sorry, I forgot to announce today's sponsor. Today's sponsor is Von Trapp Brewing. They will be a surprise as we are to announce their sponsorship. So we want to thank you unofficially, Von Trapp Brewing in Vermont, on Stowe, Vermont, for their sponsorship of this of this podcast. I'm not exactly sure what we get for this today, but hopefully one day we send them goodwill wishes and we drive lots of business through our tens of thousands of followers here at Real Fridays. So, Vine Shot Brewing, here's to you. Oh, it's a great beer. It's a good beer. It's a great family. It's a great story. You know. Anyway, so I was but so what's happening next? I mean, obviously the rates were in the news. Obviously the fallout. I think the market to some degree and the real estate market is adjusting to the NAR, the verdict of the NAR lawsuit. And I know that the NAR is trying to get out, sort of ahead of it to try to instill some calm amidst realtors across the country. Let's turn to Ron real quick. Ron is a realtor, and it'd be good to actually do an introduction, a little bit of Ron and his background, because he's the guy probably in the late 90s, in the early 2000s, he explained to me what a real estate agent does representing the buyer. He was like, I'm a buy-side agent. And I was like, a buy-side agent? What are you talking about? And pretty much 100% of his volume over his career has been representing the buy side. Not quite 100%. I don't want to speak for that, but I think that's kind of his brand is on the buy side to represent the consumer as they seek to buy a home. What's the word in Minnesota? Is this good for realtors? Is this bad for realtors? And again, I'm looking for your experience. I know, none of us are professors at the University of Minnesota in the Carlson Business School. The benefit of this is the fact that you're in the trenches, Ron. You're driving the streets of Hopkins and St. Louis Park and Edina, Minnesota, and you got your ear to the ground way more than any expert does in any academic institution. So I'd love to. What was your sense of when this happened? You shared with me some really good insights when we spoke a couple of days ago. What was your take? What's your reaction to this verdict?
Well, first of all, our company is 100% buyers only. We call ourselves an exclusive buyer's agent. We don't represent sellers. We don't list homes. Therefore, there's no conflict of interest when working with our company. Along with the verdict,
that's awesome.
Yeah. Along with the verdict, I think it's just people that don't know what they're talking about getting involved with stuff that they don't know what they're talking about. It seems like just like a money grab. And some agents do a poor job of explaining to the consumer what's really going on. So the fact that somebody believes that the seller is paying the buyer's agent commission was definitely misleading. What the seller and the listing agent have agreed to is a commission paid to the listing agent. The listing agent then pays a portion of their commission to any other agent that brings a buyer to the transaction, any ready, willing, and able buyer to make sure that the transaction occurs and goes smoothly. So again, it was some misinformation, and people that were in the courtrooms were not doing a very good job of explaining why it is what it is. I just think we'll figure out a workaround for this. So I don't think there's any risk or minimal risk. But the one thing I want to be concerned about is it may push buyers to go directly to the listing agent, which then creates that dual agency situation where the buyer will have no representation. And of course, the buyer is the one that's at the greatest amount of risk when buying a home. They're spending hundreds and hundreds of thousands of dollars. They're going through the house looking for things that's going to make it enjoyable for them to live there. As a buyer's only real estate company, we go through the house looking for problems. We want to identify those problems and resolve them before the buyer takes ownership. Otherwise, if we don't, those problems then become the new homeowner's problems.
So what is your relationship with listing agents? Do they hate you? Because they have to they have to share, their commission with you, or what's that dynamic like? Is it an adversarial conversation, or is it kind of like
it's not
unnecessary thing?
Yeah, they're going to share that commission with any other agent that brings a buyer to the transaction. Obviously, their goal is to hopefully find the buyer themselves, so they can keep both sides of the commission, the listing side and then the buyer side commission. But for most of them, they're quite fine with another agent coming into the transaction as a ready, willing, and able buyer to purchase the property.
I love it. It's funny. Shant from Guaranteed Rate, kind of spoke in defense of the buyer's agent. He's the number one loan officer in the United States. And he kind of took to it in the aftermath of the verdict to kind of say, hey, you know, we've represented agents from across the United States that work diligently on behalf of the consumer. And his take on it was kind of like yours. He's like, look, the consumer is going to lose here because the consumer the natural tendency is to save money, right? And if you leave it up to the consumer, and they nickel and dime the buyer's agent, you're going to kind of get what you pay for, like anything else. And it just becomes kind of, and at the end of the day, if you're trying to protect the consumer's interest, you're doing the very thing that's going to go against that. It's going to go against it, you know?
Right.
Rick, it reminds me a little bit of that conversation. Just reminds me a little bit of one that Jeremy and I have had many times, which is kind of the for sale by owner or discount, you know, listing commission model, where it's never quite found to the right service level, right? And it sounds like it is a great way to save money, and it sounds like it should work, and it sounds like the right tech should be there, but no one's really done it right. Not to say it can never happen, but that's almost like a one-to-one parallel with what you guys were just talking about as I was hearing that. Did you hear that the same way, Jeremy? I'm curious.
Yeah, I actually was hopeful I could get Ron to talk about it a little more, in the sense of, Ron, like, to Brock's point, there are these things that are perceived protections, you know, the MLS, NAR, the code of ethics. Not that the code of ethics is perceived. I'm saying, like, these things aren't the true value that Brock's hinting at. They're not the thing that keeps your customers coming back. They're not the thing that makes you valuable to your market, your customers, and those listing agents to get those deals done. So how much of this is, hey, look, I know when I add value, the market's going to recognize that, and I don't need pretty much anything else other than that? And how much is the misunderstanding in the courtroom, the misunderstanding in this case, is going to chip away at some of those protections, to Rick's point about, like, customers may be at risk? To me, it feels like if you're valuable, you're valuable. The market recognizes it, and all the other stuff is noise. But I could have that wrong. How are you thinking about that?
Unfortunately, people will give up protection to save dollars. They will do that. I mean, it's kind of like you guys are in the mortgage industry. You know, people shop lenders. Oh yeah, I'm going to go with this lender. He's going to give me a 4.25% interest rate, and you're quoting a maybe 4.5%. But then you look at their closing costs, and you're paying $7,000 extra in closing costs. They're buying the rate down. There's a saying that I heard a long time ago that people will go with whoever's the biggest liar. You know, even though you're telling them the truth, somebody else will lie to them, and they will go with that person because they go with who's ever the biggest liar.
Yeah.
I just choked on my coffee. That was funny. Yeah.
Dude, that couldn't have been better said. I love it.
But if you don't mind, I'd like to talk real quick about why now is a great time to buy a home, regardless of the interest rates. We just did a quick little scenario. We thought that the interest rate payment difference between 4% and 8% would be about an additional $1,200 a month. Okay. I look at it kind of like at a 12 or 24 month period. You know, if we were to kind of extrapolate that, if we were to buy a house today at 8%, and 2 years from now, before the rates adjust, you know, if they come down in 2 years, you'd probably pay an extra $30,000 extra in house payments. Okay, but that's still going to be cheaper than when the rates come down and more people come into the market to buy. Now you're dealing with competition. So right now, when buying a home, we're able to negotiate the price. We're able to negotiate the terms better. We're able to negotiate seller paid closing costs. We're able to negotiate seller paid repairs, and we're able even able to get seller prepaids on interest, 3-2-1 buy down, or 2-1 buy down, etc. However, when more people come into the market and are competing for the same few properties, that ability to negotiate the price is gone. The ability to get the sellers to pay closing costs is gone. The ability to get sellers to pay for home repairs is gone. The ability to get the sellers to pay for any buy downs is gone. And you may not even be able to have a home inspection. The other things with the competition is that people are going to push the price up. So say, for example, over that 2-year period, you pay $30,000 extra in house payment, but now there's 15 people or 20 people competing for the same property. They're going to push that price up $50, $60, $75, $85,000 to buy that house. I mean, simple math tells you that $30,000 now over the next 2 years is cheaper than $80,000 later. Okay. And along with that, you'd have to include an appraisal deficiency gap. So say, for example, the house you're interested in, they're asking $350 for it, and you offer $400 because of all the competition. Well, you need to explain to the seller how you intend to make up the difference if that home appraisal comes in low. So for example, say it comes in at $370, okay, and you agree to pay $400 for it. You need to tell the sellers that you're going to pay the additional $30,000 out of pocket, which is also going to be on top of your down payment, on top of your closing costs. So that amount of money out of pocket, it gets to be extremely exponential. It's a lot of money. So again, even though rates are high now, I think now is a great time to buy. And when they do adjust and come down, you refinance, and now you're saving yourself $1,200 a month and not having to have paid an extra $60,000.
I really appreciate you laying that out. I think that is part of both the strategy in the moment, the transactional strategy with the seller, and also that advisory service that you were talking about across the relationship that makes exactly what you're talking about valuable. I have a question on it. And this, I'm always the one that takes us off in the philosophical direction, so forgive me for that. But I've always wondered this, and you brought it up, and I'm excited to ask you, how is it any of the seller's business where my money's coming from as your buyer? So if you say, I'm going to offer $400,000, I'm going to pay you $400,000 for this house, we're going to get it appraised. Like, why isn't that just you and me working together, Ron, to figure that out, so to speak? How come the seller gets so much visibility into source of funds rather than just you as the agent saying, hey, we're good for, like we told you, we're going to bring it. We're going to bring it. My money's as good as anybody's money, whether it's part cross-country mortgage or Rocket Mortgage money and part my money. The point is it's green money. Can you talk just a little bit about that when you work with sellers agents, why it's important for that visibility?
What's the listing agent doing their due diligence to make sure that the buyer has the resources to come to fruition, to actually close on the transaction? Nobody wants to get down to a week before closing or a couple days before closing and saying, oh, sorry, we don't have the resources to close on the transaction. The seller possibly has already purchased another property somewhere else, and they may be using the funds from their existing home to purchase the next home, and so on. It's a chain reaction. So we're usually the first link in the chain. And so if that link breaks, then it causes a breakage and probably the next one and so on. However, we're having less issues with that now because a lot more people have the ability to purchase a home without selling their own home. Mm-hmm. Okay, so that's becoming less of an issue, but still, it's just the listing agent doing their due diligence to try and make sure that transaction does not fall apart. And that's why people there was this big issue with love letters, where buyers were wanting to include love letters with their offers. And the problem is it's a no-no. I mean, because there's information there that could cause discrimination was definitely the concern in regards to that. However, as a buyer's only realtor, I don't do a love letter, but I actually will call the agent and I will talk to them and I will explain to them my experience over the last 30 years and why working with me and my buyers that the transaction is going to go through, and we don't need to worry about it because we've already done our due diligence up front and using obviously reputable lenders who do their due diligence and make sure the transaction goes smooth. So I work to try and build a relationship with these listing agents, and talk to them and schmooze with them, and again get them to understand, be very comfortable with working with me more so than the buyer sometimes.
Well, it sounds like what we always hear too about mortgage, your referral sources and your partners on the lending side, right? There's probably a conversation that goes on between you and them. Same thing. Hey, look, I'm looking at everything in our system here. We're good to go. This pre-approval is going to become a final approval, based on my experience. So it's really interesting too, Brock, because you were bringing up like these trust value issues, like the market hasn't found a way not to have this value. Well, that's why, because there's this like back and forth of, hey, listen, based on everything I've seen, we're good to go. That trust is really hard to replace.
Absolutely. And do we really need to replace it? I think is probably the better question. Yeah.
Well, do we need to replace it? Because the real question is, how much of the affordability problem is our problem? I mean, honestly, like houses.
Who's going to determine whether there's an affordability problem? The buyer, the listing agent.
If policymakers aren't going to do if policymakers aren't going to do anything about it, like to your point, Brock, we've made it our problem now as realtor partners, real estate agent partners, mortgage partners, title. It's like we have this cost concern, and it's true. We do. We should be constantly trying to lower it and constantly trying to make homeownership more affordable. But that's really the question: like, whose job is this to lower the cost of homeownership?
Really, everyone's just trying to get to certainty, but hard to figure out who can give that certainty unless you have a seasoned. And
I wonder from a process standpoint. I imagine it would just get locked down in the purchase agreement wherever the split occurs, because obviously the purchase agreement gets submitted to the lender, and then at some point in time the numbers have to get accurately reflected and not change from the point in time the CD gets issued prior to closing, right? So I think what's interesting is it's going to introduce a variability that at least isn't there today. In one that could, whenever I look at variability, I always look at complexity. If variability increases, then complexity will naturally, increase as well, and it could create some confusion in the transaction. But
is that kind of what, Ron? Like when you think about it, do you just think there's going to be kind of an extra step when you meet a potential buyer? Where they're going to just be, it's just going to be more of a negotiation of what commission's going to look like, or like, do you think there's going to be different, like flat fee buyers agents, like, or do you think there's going to be more models that emerge because of this? I'm sure you're going to, with your background, I'm sure you're still going to be able to make a similar amount, but for the random realtor on the street, are they going to be getting less commission? Are they going to sometimes get more, sometimes get less, and they just have to negotiate it every time? Like, what do you think?
Well, that's how it's always been. It's always on this home you might get more, this home you might get less. It kind of all works its way out. I mean, I had a client I worked with. I've been with her. She had kind of a unique situation. We've been looking at houses for 2 years, and everything she wants to look at is an hour and a half, 2 hours away from my area. And essentially, at the end of the day, I'm making zero working with her. Whereas other clients, the majority of our clients appreciate what we've done for them, and they don't question how much money our company is receiving for the transaction, because at the end of the day, they got what they wanted, and that was to get a home for the right price and right terms. Mm-hmm. So I don't know where it's gonna end up. I know flat fee or by the hour so is not going to work out very well, because people don't realize that, we've shown you 100 homes, okay, and you want to pay me $50 per home for my expertise of seeing that property. Well, now we're at $5,000, and then let's add in there the value that we add for negotiating, the value we add for managing the transaction, and guess what? You're pretty much right at where it would have been regardless of the co-op split via the MLS.
And talk about protecting consumers, they're going to end up, and especially in an inventory constrained market like this, like they could end up spending those $5,000, $7,000, $10,000 and not end up with a home, right? So
yes,
it's it very well could backfire if that's the way it goes.
Right. When I meet my clients now, and when the market's really hot, I tell I'm going to tell you right now, the first house that you fall in love with, we're probably not going to get it. The second house you fall in love with, we're probably not going to get it. It may be the third, fourth, or fifth house before we actually get something that you like, that we can work in the transaction, just because there's so much competition. Luckily for us, we work a little bit different. I had a client a couple years ago. Market was hot. Sellers were asking $450. They put it in the coming status for about 3 weeks. My buyer calls me, goes, Ron, I want that house. I'm like, well, I'll do my best. So we ended up offering them 508, but we got the house. It's just crazy how, our expertise is able to structure these transactions so our clients actually get the house. Another example is a client closed early this year. I bought them a house 11 years ago. They sold it, moved to Florida, and then they were coming back to Minnesota to be closer to family. Their house came on the market again. Their exact same house that they lived in before it came in the market. And so we wrote an offer on it before it went live. The seller was willing to accept the offer because they knew that we had my buyers had owned it previously. But their agent did a great job and said, no, you need to wait for this house to go live on the market. So instead of paying $35,000 over, we end up paying $100,000 over. But we were still not the highest offer. So I told my clients, I said, the fact that the sellers know that we used to own this house is that's going to give us probably a $5,000 to $7,000 advantage. And that's exactly what it ended up being. And so, but this particular buyer, I didn't even meet him in person until after we closed on it the second time. And I brought them the keys to their house. The first time we purchased it, I never met him in person. The second time is when I met him. So we've had a lot of clients that will come to Minnesota and buy houses based upon our expertise and our knowledge. And I haven't even met him. I had a lady move from California, never even met her. So that's the nice thing about being an exclusive buyer's agent. People have more inherent trust in our process.
Yeah. Because you guys are so aligned with them, and that makes sense. And this lawsuit could undermine some of that. That's super interesting.
That is fascinating. It's interesting in going on your website, Ron. You make it very clear that you're not a realtor buyer kind of scenario. You're not approaching sellers to buy their home to then flip it and turn it around. I mean, you're strictly representing the consumer. And it kind of made me, reflect on the innovation that often exists in real estate. Cause there's a lot of sales guys in the business. There's a lot of different innovations. Like on the real brokerage side, there's the, becomes almost like the, 6% commission, the 5% commission, the 4% commission, the 3% commission, the flat wage commission kind of situations. And then you get these tech companies who, in essence, are squeezing out realtors who want to buy, sell, finance, issue title. I'm not going to mention Zillow, but I'm just sort of transitioning to the iBuyer status and what happened with the iBuyer, right? What happened with the process of that? And I'm curious, Jeremy, on your side, but I'm curious from a real estate agent side on what not just the reaction to the market, because of course anything that's threatening is going to have an adverse reaction to it. But do you see those types of things? I'd be curious what your perspective is. You see 50 years from now, I want to hear Jeremy's perspective on iBuyer first, but on your perspective, Ron, 50 years from now, do you see any change on what it means to be a realtor and how that business is done? Do you see any consolidation? Do you see 50 years from now? We're long retired, hopefully, right? Yeah. But I'm curious on your thoughts on that. But Jeremy, talk to us about iBuyer because I know that these properties are still underwater. These companies are still sucking wind financially and they bought all this inventory, the homes, they can't get out from underneath them. So what's the future there?
I guess I'll go this direction, which is to say, Ron mentioned it earlier, like liquidity is a tool and liquidity is valuable. It has a value, it has a market value to it. So conceptually, I don't think the model was wrong to say there are some consumers in the market who need liquidity and understand the value of it and will pay for it, pay for liquidity. And whether that's in a seller's market where I need some flexibility to be able to win the house and then backstop some finance, in a buyer's market where I need or I want a bridge because I'm selling a previous house and I need a bridge to be able to manage the timing. Like just like we were saying, there's a cost to that in the market. So I think the question became cost of capital, and there's a disconnect, in my opinion, between the primary market and the secondary market for mortgage debt and for real estate. What I mean by that is we've disconnected it in a way that we can't quite get the flexibility and the tools to the consumer that needs them at the right return for the capital that can go do other stuff. And what do I mean by that? If I can give a buyer liquidity in a transaction to win the house, I have enough capital to also just buy that house and rent it out. Mm-hmm. So the capital markets that are using these proceeds to go do things in real estate are going, why am I going to get 3.5% return helping a consumer when I can get 7% return not helping a consumer, or 10% return, or 12 or 14? And it's a no-brainer for the portfolio manager of that money to go 12 versus 3. Like, I'm getting the 12. And so there is a disconnect to say, like, it isn't about the consumer not needing this liquidity or flexibility. I think we need more innovation. I think we need more in the toolkit for pros like Ron, for consumers. They need more tools in the toolkit. The problem is we haven't quite figured out how to deliver those tools at a cost the market can bear without continuing to drive up prices instead of down.
But a lot of it has to do with the financial education of our society too. And people, I mean, I've had clients where we've negotiated a great deal, explained it to them, and then they go to their parents and their parents poo-poo it. And then we buy it a slightly different way. And I'm like, wow, you just left $5,000 on the table. We could have saved another $5,000, but because you didn't listen to me, you listened to your parents who have bought 3 houses in their 60 years. And I bought 3 houses for clients this month. I think my experience is a little bit more valuable than mom and dad's. And God love them, but they're meaning to do their best, but they just don't know what they don't know.
We've always talked a lot on this show, Ron, about getting the right data or the right information to the right person at the right time, right? Yeah. There's a financial literacy piece of that for consumers, but it's also like, Rick, to your point about tech platforms, I've always been pretty optimistic that one thing tech does do well is it moves data or moves information around in a timeline or temporally to get it to the right person, to get it to the right place at the right time. And Ron, are you seeing any tech tools or platforms that have come into your business or that are in the market that are helping you make that case better, make that case stronger, or interact with your consumers better to avoid some of the like myth or perception versus the reality? It's
just me talking to them.
Got it. Okay.
And once you do that, they're like, wow, I never thought of it like that. And I mean, it's simple math. I mean, it's just simple math, but you gotta, I know one of my lenders, I use a lot of stories to explain my points, but I had a lender years ago. I was talking to her and I said, hey, how much do you want? How much would the payment be on a $300,000 property? And she said, well, if you use the interest only loan, it'd be this. And I'm like, but Gene, you got to pay the loan back. And she's like, Ron, do the math. But Gene, you got to pay the loan back. She's like, Ron, do the math. But Gene, click. She hung up on me. She was not going to beat it to me that, it's with appreciation, you don't have to pay the loan off as fast as you think you do. And actually you want to pay it off slower. But that information is just not getting to the consumer. People out there are like Rick Edelman and Robert Kiyosaki and Stephen Marshall and Doug Andrews. They put that information out there. But then we do have another gentleman out there that seems to tell people that the tax write-off for people is not worth it. And it's like, but dude, you don't understand that people don't have $300,000 lying around in their bank account to go buy this property. So they either are going to be making interest or paying interest. And for a lot of people that, the amount they're paying in interest is well worth it for them to get into a property versus never getting into a property, because the home values appreciate faster than anybody could, or most people can save. And I'll talk to people like, how much you saving? Oh, I'm saving $500 a month. Oh, well, you do realize the neighborhood that you want to get into is going up $2,000 a month. So either you cut bait and go and jump in the market now and buy, or wait. And if you wait, that house you want to buy is gonna be $60,000 more.
Yeah.
So you lost out on that appreciation. So it's always best to get in the market when everybody else isn't.
Yeah, you definitely don't want to, we don't want to showcase any names or anything, but that person who works over at Ramsey Solutions, he definitely, he's a contrarian voice to housing, today. And a lot of loan officers and real estate agents are very much, it rubs a lot of people the wrong way. I think it's a good message around, avoiding debt as the consumer, or really managing your money more responsibly. But I think the application of it doesn't really make a lot of sense to me. But I mean, certainly it resonates with a lot of people, and then it turns off a lot of people at the same time. But so where do you see, I'm a big advocate of tech innovation, and of course, I kind of liken the evolution of tech in service-driven industries like toll booths. There was a lot of pushback by unions and so on to get rid of manual people who give you the ticket or collect the 50 cents at toll booths and highways in lieu of the automated coin exchangers. One Clear was a much better innovation. And then there's the easy passes now that you can just zip right through, the toll plazas. But it took a long time for that to adopt, because it was forces that were resisting change. Clearly there are clearly innovations and pressure points to real estate into kind of streamlining the transaction. So that you are in the end saving the consumer money. I don't know how you get rid of the kind of any industry that provides a lot of TLC, a lot of hand holding to the consumer, that emotional connection. It's hard to put an algorithm to that. I think it's hard to sort of scale and apply better technology to improve an emotional comfort level with a transaction, right? I think there's things that you can do to potentially bridge that gap, but it just presents the challenge, right? So where do you see it, Ron? In 50 years, where do you see it? Do you see a role? I mean, I've been in this business on the mortgage side for 20 years, and we've been forecasting the death of the realtor for 20 years, right? And in that 20 years, we've also been forecasting the death of the loan officer for 20 years, saying the loan officer is going to get squeezed out, right? Technology is going to squeeze out the loan officer. Technology is going to squeeze out the realtor. Neither really has happened. The economics really haven't changed. The realtor commissions haven't changed. Realtor commissions haven't changed in 30 years, 40 years, So how do you see it 40 years from now? Do you see it pretty much the same, which arguably it could be?
Well, unless you can find a way to build houses that don't deteriorate, that don't have leaks, that don't have things that break, there's always going to be a need for buyer brokers and for inspectors. Obviously, we're looking at it from the financial perspective, and the inspector's looking at it structural. And I mean, again, unless you can find a way to build a house that doesn't deteriorate and will be status quo the whole, forever, it's going to always be a need for them. And the people are always afraid. They're just afraid of the unknown. And so, people will share with us their concerns. And, obviously, since we've been through it so many times, it's like, that's a non-issue. But we'll make sure that we address that issue and take care of it for you. But for the most part, a lot of it's non-issues.
I mean, I think the two things, Rick, that come to mind for me, one, your example of the toll booth is a good one, because we've been stuck in a linear fashion in this industry. And so everybody is trying to do the easy pass, because they're still imagining a linear transaction from start to finish. We've not done a great job, like I said earlier, moving data around or moving the timing of certain things around to fundamentally change certainty, verifications, confidence, and trust, the way Brock was talking about, right? So the example that I really appreciate, the ex-CEO of Rocket Mortgage, Bob Walters, used to say, he used the F1 pit crew as the example. We've introduced more humans to the pit crew, and the pit crew's gotten faster. The car's gotten faster and safer and better. It isn't about the number of humans. That's the wrong way to think about it. Are the humans surrounding the problem, surrounding the car, helping the driver, are they better, faster, stronger thanks to data and technology? And are we getting gains, measurable gains around speed, winning, championship cups? It's not a perfect analogy because that's entertainment and this is financial services. But my point is, why aren't we focused on that? Why aren't we focused on the measurable wins and how to put more data and technology around the experts to make us better, faster, stronger, instead of like what you said, which is taking something that already exists and just putting it on top of the street instead of next to the driver's side.
The problem, Jeremy, and I think Ron can sort of attest to this, and I think the makeup of this group kind of speaks to this as well. Your analogy of the NASCAR pit crew is a good one.
Yeah, he said F1.
To be clear.
F1? Yeah, sorry. Sorry. But the reality is those are all individuals that have separate jobs that are all operating under one roof, under one management team, under one structure. And the problem is when you have title, which is, you're on title tech innovation. I'm on the mortgage growth side. You got a realtor on the buy side, real estate agent side here. And then you're on the tech innovation, with Brock. I mean, it's hard to unify all of these competing interests, right? We're all sort of elbowing. There's only this much room at the bar and we're all elbowing our way to the bar. Right. If we were all one part, I think 50 years from now, to your point, or to my point earlier, it clearly there's going to be automation, and clearly we're going to sort of the process is going to get streamlined in each individual bucket. I just don't know how the bridge is going to get. We could probably close a loan, notwithstanding any regulatory reforms that would be required. We could close a loan in same day. We could originate and close a loan on the mortgage side same day. There's almost no reason why we couldn't, right? Again, there's some regulatory reforms that would be required, notification updates and time requirements and so on. But the reality is, we could do that in a day. The realtor is going to have their role within a day. You know what I mean? The title company will have their role within the mortgage process. I see components of that being streamlined. It's just that there'd have to be a real convergence of forces here. There'd have to be a real East-West merge culturally in order for this to be successful. And that's the piece if the issue was just technology, I think that could be done. But the problem is it's not about that. It's a cultural clash. There's a human clash. There's a generational clash. I think a generation is described as a 50 or 55 years. I don't know if it's going to look a lot different. I think the mortgage piece will look different. I think
you're both right. You're both right. The thing is, the consumer doesn't want to deal with 20 people. They only want to deal with one person who's the conductor, or like at a restaurant. You deal with your main waiter, main waitress, and they're the ones that build the relationship with you at the table, even though you're only there for an hour or whatever. But then you have everybody else running out food to you and stuff. You don't really engage with them. They just put your food in front of your face, but you engage with your server. And at the end of the thing, that's the one you put the tip on, not based upon the person that put the plate in front of you, did it in a very nice way. You don't care about that, but it's that your server built that relationship with you. Same thing with the lenders, same with the agents. You're building that relationship with that person, and that's what people are wanting. They don't want to deal with 10 people. They want to deal with one person.
Well, this is good. Well, I actually have to jump. I have my next meeting that started actually about 5 minutes ago. I wanted to thank you, Ron. Ron, always good to see you. You've been a good friend of mine for 20 years. I've always loved what you've done in the Twin Cities and the professionalism you provide in the real estate brokerages and in the transaction. I mean, you're the best of the best. Happy Veterans Day to you as well. Thanks. And Jeremy and Brock, always good to see you guys, man. Brock, you get younger and younger each week goes by. And Jeremy, it's not common that you're late. So it was amazing to see you 3 minutes late. So
Right on.
Well, gentlemen, it was nice meeting you
Thank
today.
you, Ron.
I appreciate that. Wonderful man, Von Trop will send us some beer though. So
Yes, I can't wait to get the cease and desist from one of these sponsors. We'll see you.
Funny.
We'll see you guys later.
Well, have a great weekend, guys.
Bye.